Today, is it intergenerational war then? Hello again, it's Martin North from Digital Finance Analysis. Well noticed posts covering finance and property news. And okay, folks, a rant warning. It seems you're better placed financially and socially if you are old with property compared with being young with none or a massive mortgage. And it's structural, thanks to bad policy across the board. One reason why younger people are turning away from the major Uniparty. If you're one of the many thousands of younger Australians struggling to try and get on the property ladder, you'll already know that there is a war on youth. Thanks to mass immigration, a permanent per capita recession, the rent shock, the energy shock, unaffordable homes, crushed wages, rampaging mortgage repayments, destroyed and expensive education. Oh, and add in there a ruined built environment, a wrecked natural environment, and perhaps even a dying planet. But older Australians are in a completely different world. CBA says Australians are freeing up more of their wallet for discretionary purchases with a focus on value and convenience, according to the latest CommBank IQ cost of living insights analysis. Overall spending continues to trail inflation, up by just 1.5% compared to the same time last year. But younger Australians continue to feel the pinch more than any other age group. And those aged 18 to 29 are cutting back on spending by around 2% over the past year, with a notable decline in both essential, down 2.3%, and discretionary, down 1.9% spending. In the past 12 months, those aged 30 to 39 years have also recorded negative overall spending growth, with a 1.1% drop in essential spending and a 1% drop in discretionary categories. But by contrast, those aged 60 to 69 increased spending by 3.9%, and the over 70s by 7.7%, underscoring the continued generational spending gap. And earlier this month, Exit Research released a survey showing that only 15% of respondents believed that younger Australians could purchase a home without financial assistance. The results followed an analysis from Money.com showing that home buyers need to save a deposit of nearly $200,000 to purchase an average price home with lenders' mortgage insurance. And separate analysis from the Reserve Bank published this week showed that the median deposit for first home buyers soared to $157,000 from $89,000 in 2019. The RBA Assistant Governor Christopher Kent noted that first home buyers' share of new loans have been a bit above average of late, suggesting the so-called bank of mum and dad may have increasingly helped many first home buyers. And the latest ANZ CoreLogic Housing Affordability Report has revealed the impossible barriers facing Australian first home buyers. The national dwelling value to rent ratio hit an equal record high of 8 in the September quarter of 2024. And at the same time, Australian mortgage rates have roughly doubled from the pandemic low. And the combination of higher prices and mortgage rates has pushed the percentage of median household disposable income spent on mortgage repayments on a medium-priced home to a record high of 50.6% nationally. At the same time, the time taken to save a deposit is tracking near a record high of 10.6 years nationally, up from the 20-year average of 9 years. However, saving a deposit has become much harder due to rental affordability collapsing to a record low. So as you can see here, the percentage of median household income spent on rent has hit a record high of 33%, up from the 20-year average of 29%. So all up, record high home values, high mortgage rates, and surging rents have combined to create a perfect storm of factors which have made home ownership a nearly impossible dream without family financial assistance. In fact, CoreLogic head of research Eliza Owen commented that home ownership is not realistic for a median income household, which is about $101,000 across Australia, to put down the 20% deposit on the median priced home at the average owner price mortgage rate without assistance from the bank of mum and dad. It's basically impossible at current mortgage rate levels, she said, especially for those who don't have access to intergenerational wealth and are just relying on their income to break into the market. We can't assume that everyone has a workaround to get into the housing market, like the bank of mum and dad, or moving somewhere cheaper, or buying something smaller. It really just highlights the damage the ongoing rise in prices is doing to people's ability to get into the property market, AMP Chief Economist Shane Oliver added. With housing affordability at a record low, according to PropTrack, and the gap between home prices and borrowing capacity at an all-time high, first home buyers are as reliant as ever on family financial assistance. In fact, if you don't have wealthy parents to tap for assistance and you live in a major Australian city, the chance of owning a home is slim to zero. Intergenerational wealth transfer has replaced the Australian dream of home ownership. And we also know from our surveys that younger people are under huge mortgage pressure, something which the RBA has only just started to talk about, better late than never. And, for example, the RBA Assistant Governor Christopher Kent spoke about how rising interest rates have hit Australian households particularly hard. Although the official interest rate in Australia rose by less than the average interest rate on outstanding mortgages in Australia is among the highest in the developed world. The more significant rise in mortgage rates in Australia is because it has one of the world's highest share of variable rate mortgages. In Australia, most private sector debt is subject to variable interest rates. Even fixed rate debt tends to be fixed for shorter periods compared with other economies. Christopher Kent noted. At the other extreme, most mortgage debt in the US is fixed at 30 years, and large corporations issue a lot of fixed-rate bonds. Over recent years, some of the most rapid increases in average outstanding mortgage rates occurred in Australia and Norway, which also has a high share of variable-rate mortgage debt. This is despite policy rates rising by less than in those economies, compared with many other advanced economies. Kent said, compounding the situation for Australians is the fact that our households carry one of the highest debt loads in the world. Combined with the significant rise in outstanding mortgage rates, this has led required mortgage payments, interest plus principal, to increase by 2.5 percentage points of total household disposable income since May 2022. The increase as a share of mortgage holders' incomes is much larger still, Kent noted. These mortgage payments have reached record highs in Australia. And this chart shows why the RBA did not need to hike official interest rates as much as other countries to lower demand and inflation. The RBA's monetary tightening has been particularly detrimental to Australian households because Australia's real per capita household disposable income suffered one of the world's largest declines due to falling real wages, rising mortgage rates, and increased income taxes. But on another planet, far, far away, cash sales in property surged 14% to $183 billion across New South Wales, Victoria, and Queensland over the past financial year, fueled by, wait for it, wealthy downsizers, retirees, and investors, according to a new report. An analysis of settled residential property transactions by electronic conveyancing firm PEXA found that the volume of all cash purchases also increased by 3.9% to 141,000 properties, largely reflecting a stronger property market in the financial year for 24. While the share of properties sold without a mortgage shrank slightly in volume terms by 0.4 of a percentage point to 26.5%, from a year ago, the proportion of cash purchases by value rose to 28%. Julia Toth, PEXA's chief economist, said the sheer number of cash buyers would continue to support house prices. This segment is less affected by interest rates, and they comprise a large proportion of the market, which I expect will continue to rise in line with the aging population, she said. The amount they spend on property, 28% of all transactions, is substantial, which is one of the reasons why the housing market stayed resilient in the past year. Michaela Fakir, Jarden's chief economist, said generational wealth transfers and rising investor lending has driven this housing cycle, along with an increase in listings. This dynamic has also avoided a much sharper housing downturn, she said. Wealthy cash buyers flocked into desirable inner suburbs of Sydney and Melbourne, and older retirees splurged on regional properties across the eastern states. In fact, Sydney, postcode 2000, was the most popular among cash buyers, with $1.7 billion worth of property bought without a mortgage. That's the highest in the country. Buyers bought 540 properties in cash deals at a median value of $1.65 million. Surfers Paradise on the Gold Coast followed, with $1.6 billion worth of properties transacted without debt across 1,206 properties at a median sales price of $820,000. Blue chip suburbs like Mossman, Darling Point, and Bondi Beach in Sydney, and Brighton, Toorak, Kew, and Balwyn in Melbourne were also in high demand among cashed-up buyers, who poured in between $400 million and $1.1 billion in each of those areas. Postcodes dominated by apartments such as St Leonard's, Waterloo, and Randwick in Sydney also recorded large amounts of cash sales as buyers snapped up between $500 million and $800 million worth of properties across those suburbs. Eliza Owen, CoreLogic Head of Research, said the slower growth in housing markets across Sydney and Melbourne could attract more cash buyers to the market. Given some sharp price declines across some of the high-end markets of Sydney and Melbourne, there is an argument that those who are looking for a counter-cyclical buy, it would be better for them to get in before the next rate cut comes around, maybe June next year, she said. But hold on, because house prices have plummeted by as much as 9.7% across Sydney suburbs like Rod Point, Abbotsford, and Balmain East over the past 3 months to October. That's according to CoreLogic's data. And similarly in Melbourne, housing values have slumped 9% across Albert Park, 8.6% in South Melbourne, and 6.1% in Elwood. Independent demographer Mark McCrindle agreed that falling house prices could spur on more opportunistic cash buying. If people have cash and can take advantage of the current buyer's market, that would help sustain house prices, he said. So Australia's property market is not likely to see a significant fall or crash because there is a lot of money available sitting on the sidelines and able to step in when there are buying opportunities. So even though the rising listings may be a perfect storm for young house buyers, it's also an opportunity for cash buyers who largely are in the older generations. Tara in rural Queensland posted the highest proportion of cash purchases at 77.4%, followed by Russell Island, located north of Brisbane, at 76.8%. Those sales were dominated by vacant land, which sold at a median price of $77,000 and $65,000 respectively. There was also an unusually high proportion of cash purchases in postcodes that has been affected by recent flooding or at risk of future flooding, such as Lismore, postcode 2480, and Moama, postcode 2731. Tooth said this could indicate that potential buyers in those regions might struggle to secure insurance and or mortgages because of financial institutions' concerns regarding environmental risks. And in the capital cities, Milsom's Point in Sydney's lower North Shore recorded the highest proportion of cash sales, with more than 1 in 2, actually 54%, transacting without a mortgage. And the investor-dominated postcodes of Melbourne 3000 and 3053 Carlton also attracted high proportions of cash-only transactions, about half sold without a mortgage. Those postcodes include a lot of student accommodation and also new high-density dwellings being constructed, which tend to be regarded by financial institutions as high risk, Ms. Toth said. However, investor demand for those dwellings is likely to remain high, especially given the record high intake of international students in recent years. However, the market is looking shaky, with last weekend's combined capital city preliminary clearance rates about the lowest third of the year to date, coming in at just 64.1% compared to 65.8% the week prior, which, by the way, was revised down to 58.4% in the final numbers. Melbourne's preliminary clearance rate was 64.9%, down from 66.5% last week, and revised down to 59% in the final numbers. And in Sydney, only 63.4% of auctions were reported as successful based on the early collection, the second lowest preliminary clearance rate so far this year, after the first week of October when it came in at 62.7%. Commenting on the results, Leading auctioneer Tom Panis noted that homes were selling for significantly less in Sydney than a few months ago. I'm seeing result after result of property selling significantly lower than what they could have gotten a few months ago, Panis said in his weekend wrap. There are buyers out there that are wasting this golden opportunity to secure a property at a much lower figure than what they were paying a few months ago. CoreLogic's Daily Dwelling Value Index supports Panis's view, with Sydney and Melbourne recording falling prices. Oh, and by the way, in case you think this is something unique to Australia, it's interesting to note that more than half of New Zealanders with mortgages may be suffering mortgage stress, putting them at risk of not being able to pay their mortgages. Data released by the Finance and Mortgage Advisors Association of New Zealand, the FAMNZ, found that 3 in 5 New Zealanders, or 59%, may be suffering from mortgage stress, which affects mortgage holders with repayments that are 30% or greater of their household income. Sidebar, of course, that's not a good way to define stress, but nevertheless, that's what they used. The research also found that nearly 1 in 4 spent more than half of their income on mortgage repayments each month. FAMNZ's Consumer Access to Mortgages 2024 report found 37% of New Zealanders said their financial situation had worsened over the last 12 months thanks to an increase in the cost of necessities, utilities, and rising interest rates. Those who owned their own home with a mortgage or who were renting said they were financially worse off than a year ago, while those living with family or owning a home with no mortgage said their financial situation was about the same. The study also found that 1 in 4 mortgage holders were actively considering refinancing, while 20% had already taken that leap. However, for some consumers, this is not an option, as 27% of borrowers under stress may be considered mortgage prisoners, believing they will be unable to refinance due to new servicing requirements or other financial circumstances. While Kiwis experiencing mortgage stress had a tough year, another official cash rate drop was indeed on the horizon, different from Australia, I think. So, standing back, it's better to be old with property than young with no property or a massive mortgage. And the intergenerational gap is continuing to grow. The trouble is, unless things change, trends are set to deteriorate further. Sure, if you have parents with property who will one day fall off the perch sometime in the future, you may get a look in. But if not, permanent renting is the order of the day. So much for the Australian dream of property ownership. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.